Okay, let's start this class. So last class we discussed this recapitalization when there's tax. And so let's first review this example. We learned that this recapitalization example by discussing how the firm's value would change if there's a tax and how the firm's stock price would change if there's a tax. So let's look at this example we discussed. So there's this firm, it has 20 million shares and it has a per share price of $15. It has no debt. And then the firm tries to borrow $100 million. And this is a permanent debt. And it uses this permanent debt to repurchase its shares. And we assume the corporate tax rate is 35%. Now the question is, how would stock price change? And we learned the correct way to solve this is we need to first examine how the firm's value will change. To be more specific, we know that the firm's unlevered value was $300 million. Right? So it's 20 times 15. And then we have to consider the effect of leverage. And we learned if the firm has permanent debt, the present value of its interest tax shield is given by corporate tax rate times permanent debt. So in the end, the firm's value would be increased by 35% times $100 million of debt. So this is $335 million. You can consider this as the first step. Now, what is the second step? Well, if you think about this, if every shareholder understands this process, that is, using debt will increase the firm's value, then every shareholder will want to demand a higher share price. So this implies that once shareholders understand the firm is trying to do this leverage recap, the share price should increase, right? So this basically implies every original shareholder will benefit from this value increase. This result is quite important because it directly gives you the result on the new stock price. So we have a total value of $335 million and we have 20 million shares. So this gives us a price of, I believe it's 16.75. Let me find out. Okay, so it's 16.75. So you can see that in terms of finding out the correct answer, this is easy, right? So the only caveat is you have to understand all original shareholders will get the benefits. Okay, now let's see an example. And this example will conclude this section. So suppose the same firm, Midco, so we are still in the same example. The firm announces it will purchase $100 million of shares and show that 16.75 is the lowest price it could offer and expect shareholders to tender their shares. So here tender shares essentially means sell shares. So essentially this question says you have to show that 16.75 is the lowest price that shareholders are willing to sell their shares to the firm. And how will the benefits be divided if Midco offers more than $16.75 per share? Well, you can just start with the share price, which is smaller than 16.75, and you can see what will happen. Right? Let's assume a purchase price of $16. And then if the firm has $100 million of cash from issuing the debt, now how many shares the firm can purchase? Well, it's 100 divided by 16. So I guess it's 6.77. Right? And this tells us the leftover, right? That is, how many shares are left in the market. So we know there are a total of 20 million shares. So we know 13.33 million shares are left in the market after the purchase. Now, what is the price of these 13.33 million shares? We know the firm's value will increase to 337, right? Sorry, 335. And after paying out $100 million, so the firm's equity's value would be 235. So the after purchase stock price will be given by the total value of the stock divided by the number of shares. Right. So let me find out what's the, we don't have an answer here. Okay, I have to use the calculator on my computer. So this is 235 divided by 13.33. So this gives us 17.63. So this one is actually sort of the same as the round approach we mentioned in the last class. So what you can see here is the purchase price is $16, but the after purchase price is $17.63. So this implies that if the firm indeed offers $16, no shareholders would want to offer their shares for sale at $16 because they understand if they do this, then after the purchase, the share price will increase to 17.63. So the best option for them is to just wait, right? Just wait, and in the end, if other shareholders are willing to sell their shares at $16, in the end, if you wait, you will get this higher price. So obviously, every shareholder will want to wait. So in the end, no shareholder will want to sell shares to the firm at $16. Okay, and then obviously you can show that at the price of $16.75, the purchase price and the after purchase price will be the same. We have done this in the last class. So that's why a firm could purchase at this price, and that's why shareholders will be willing to sell shares at this price. Now, the second question is, how will the benefits be divided if Midco offers more than 16.75 per share? Well, you can try this. Let's assume the firm is willing to pay a per share price of $20. Now, in this case, using $100 million, the firm can repurchase 5 million shares. So the leftover, the residual number of shares in the market will be given by 15. So what is the share price for these 15 million shares? So again, we would use the total value of equity, which is $235 million, divided by the number of shares, so which is 15 here. And the value is given by, and the value is given by 15.67. Now, if you compare numbers, right, you can see the opposite case. That is the purchase price of 20. It is actually larger than the after purchase price. So this means as a shareholder, you don't want to wait, right? Once the firm says, hey, I want to buy your share at $20, then every shareholder will want to sell their share. Because if you wait, you will suffer from a loss. But obviously, not every shareholder can sell their share because the firm is only trying to repurchase a portion of their shares. So in this case, potentially, the firm can offer a lottery system, right? So there could be some random draw among its shareholders. So if you're lucky, then you could sell at a price of 20, and if you're unlucky, you cannot sell, then you would have to suffer from this loss. So you will have to get the after purchase price of $15.67. Okay, now let's look at a second type of tax, that is personal taxes. Clearly, when you're talking about corporate tax, then you should talk about personal tax. Why? Well, because think about the valuation. As an investor, as an individual investor, you ultimately care about your after-tax cash flows from your investment, right? Obviously, from the individual level, the after-tax cash flows will be affected by personal taxes, right? So clearly, depending on how equity income and interest income are taxed, investors could have different preferences over equity and debt. Essentially, this implies personal tax will affect the interest tax shield. Generally, so basically the interest tax shield will be affected by both corporate and personal taxes. And in real life, we know that generally, interest income has higher tax compared with equity income. So this essentially means because of this personal tax differences, the after-tax cash flow from debt will actually suffer. So this difference in tax or the higher tax of interest income will actually reduce the benefit of interest tax shield. So let's first look at some actual tax rates in Canada. Of course, this is an old table. It's 2013, but it's pretty easy for you to find out up-to-date information by just Google it. So let's look at several different kinds of income taxes. So our main focuses are tax on interest income, and tax on capital gains, and tax on dividend. So here both capital gains and dividend are considered as equity income, right? Because what is capital gains? Let's say if you bought Apple at $80 and you sold it at $100. So your capital gain is $20, right? So this is obviously your equity income. What is dividend income? So let's say you have one share of Apple, and Apple will pay you 30 cents per share every quarter. So your income of 30 cents per quarter is considered as dividend income. And this is obviously a type of equity income because it's income from holding equity. So our major focus is we want to compare the interest income we want to compare the tax rate on interest income versus the tax rate on equity income. Of course, you can see that there is difference on the tax rate for capital gains and for dividend. Generally, capital gains have lower tax compared with dividend. But what you can also see is, which is the more important observation here, ordinary income, that is the interest income tax, is most of the time higher compared with both capital gain tax, and dividend tax. So what we can do is we can look at the average equity tax, right? So now let's shift our major focus to this column and this column. So here, average essentially refers to the average of the capital gain tax and the dividend tax. So this is the average equity income tax. You can look at these numbers. What you can see here is for every province or territory in Canada, the tax on interest income is always higher than the tax on equity income. And you can also look at the average. So on average, Canadian with the highest income tax bracket, oh, I forgot to mention that. This is tax rates for the top tax bracket, that is the highest earners. So for these people, they have to pay 44.73% of their interest income as tax. But for the equity income, they only need to pay about 25%. So the tax on equity income is significantly lower compared with the tax on interest income. So clearly, as a investor, facing with such a large difference in tax rates, your response is you might want to prefer equity, right? Simply because of the tax advantage. This implies that the advantage of interest tax shield will be smaller because of the tax disadvantage in interest income. So let's look at a very simple example. Let's say there's a firm. It has this earnings before interest and taxes, which is 1 here. So EBIT is $1. And then there are 2 ways to pay out this EBIT. The first is paid as interest income. So in this case, you can see that at the firm level, so here, so for the first row, we're talking about firm level. Here we are talking at the investor level. So what you can see here is at firm level, essentially this interest income is tax-free, right? Because again, it's because interest expense is considered as expense, so it will be deducted. And then if we go from the firm level to the individual level, you can see that obviously as a debt holder, you have paid the income tax TI. So the after-tax income for this debt holder is 1 minus TI. And then a second way to pay out this $1 EBIT is to use dividend or capital gain. Anyway, equity income, right? In this case, you can see that the firm has to pay this corporate tax of TC. So at firm level, the after-tax cash flow is 1 minus TC. And then at the individual level, the equity holder has to pay this tax, that is the equity income tax. So the after-tax income for this equity holder would be 1 minus TC times 1 minus TE. Here TE refers to the equity income tax, and TC refers to the corporate tax, and TI refers to the tax on this equity income, on this interest income. Now, you can see what is happening here, right? So basically you can see that first, at firm level, debt simply from the perspective of tax is always preferred, right? Because 1 is always larger than 1 minus TC. But at the individual level, this could be different. That is, this I is larger than this TE, right? So this larger interest rate, this larger tax on interest income can pretty much reduce the benefit of interest tax shield, right? So how do we measure the benefit of tax after considering personal taxes? Well, we have a formula for this. You can see that the formula is constructed in the following way. So basically, if the firm pays out its EBIT as interest income, then you can see that the after-tax cash flow is given by this. And then for equity income, its after-tax cash flow is given by this. So the benefit of tax would be measured by the percentage difference of these two cash flows. That is, you will use 1 minus TI, the cash flow from the interest income, minus 1 minus TC, 1 minus TE, the after-tax cash flow from the equity income, then divided by 1 minus TI. Right? So we call this formula, or we call this measure, as the effective tax advantage of debt. So this is the formula here. And basically you can see that using this graph, you can understand why we construct the effective tax advantage of debt like this, right? How do we get this formula? And then obviously, these two guys, if you, it's very quickly for you to see that this equality will hold, right? So basically, 1 minus TI divided by 1 minus TI gives you 1 here. Now, what's the meaning of this number? What does T star indicates? Well, it indicates that for the same amount of EBIT, if debt holders get $1, then the equity holder will only get 1 minus T star dollars. So basically, you can see that here, even with higher personal taxes on interest income, we still generally consider that debt still has some positive tax saving benefit, right? So that's why you get $1 from debt, but you will only get 1 minus T star dollar from equity. And now let's look at this formula, which gives you the effective advantage of debt. So how do we understand this formula? Well, we could consider several special cases. Let's first consider the special case that there are no personal taxes, right? So if there are no personal taxes, then T star equals 1 minus TC times 1 divided by 1. So this gives us TC. So this essentially says if there are no personal taxes, the efficient tax advantage of debt is just the corporate tax rate. So this is really the basic case we discussed in this chapter, right? Recall that we started with the case of just corporate taxes. Okay, next, we discussed the case when there are personal taxes, but the tax on the interest income and the equity income are the same. So in this case, you can see that if TE equals TI, then these two parts will just offset with each other. They will just cancel out. So this gives us TC. This basically says when there are personal taxes, but if personal taxes are the same, that is the tax on equity income and the tax on the interest income are the same, then personal tax will not reduce the tax advantage of debt. Now let's look at the more realistic general case. So that is when TE is smaller than TI. That is the realistic case, right? The tax on equity income is smaller than the tax on interest income. So in this case, what you can see here is if TE is smaller than TI, then 1 minus TE is actually larger than TI, right? Sorry. The 1 minus TE is actually larger than 1 minus TI. So this basically says this formula will be smaller than this, which equals TC. So basically this implies if the tax on equity income is smaller compared with the tax on the interest income, then personal taxes will reduce the tax advantage of debt, right? Remember, what is TC? TC is the tax advantage of debt when there is no personal tax, or personal taxes are the same with respect to the equity income and the interest income. So the third case is the most important and the realistic case. Okay, let's do a calculation. So if we use the number from the table here, then we can find out what is the typical tax advantage in Canada. So what we are gonna use is we will use these numbers, right? So we will use this number as corporate tax rate, and this number as the interest income tax rate, and this is the tax rate on equity income. So we know that the effective rate is 1 minus, well, I actually cannot memorize this formula. So it's 1 minus, it's 1 minus TC, 1 minus TE, 1 minus TI. So plugging numbers into this formula, you can find out it's 1.1183%. So basically you can see that. Okay, let's first compare this number. So let's assume TI and TE are both 0. Now in this case, the effective tax advantage is just the corporate tax rate, which is 27.45%. And if you compare this number, you can see that the benefit of tax reduces a lot, simply because the tax rate on equity income, the tax rate on interest income is so much larger than the tax rate on the equity income, right? Okay, so let's look at this example. Oh, this example is also about plugging numbers. Clearly, in this section, there are basically no conceptual difficulties here. The purpose or the requirement for these several pages is about the ability to plug in numbers to find out what is the T star. So let's see this example here. It says, what is the effective tax advantage of debt in BC and in Newfoundland and Labrador? So let's just try British Columbia. If we use the table here, you can find the numbers you need. So for BC, the corporate tax rate is 25%, and for interest income, it's 43.7%, and then for equity income is 23.8%. So if you plug in numbers into this formula, so 1 minus 25%, 1 minus 23.8%, and 1 minus 43.7%. So this gives you a number of minus. So in the case of British Columbia, it's actually very interesting. It basically says that if you consider the personal taxes differences, then you can see that there is basically negative tax advantage. That is, there is just tax disadvantage. So it basically implies in BC, if a firm uses more debt, it will actually reduce its value. Right? So it's pretty interesting. And of course, you can see that for Newfoundland, the tax advantage of debt is actually positive compared with BC. So we can basically do the same thing, right? Do the same thing to calculate the tax advantage by considering personal taxes for each provinces and territory in Canada. And what you can see here is there is large difference made by personal taxes. So here you can see that, let's say for Alberta, this dark blue bar gives you the tax advantage by considering personal taxes. And this yellow bar gives you the tax advantage without considering personal taxes. You can see that the difference is really huge, right? So for each province, if you don't consider the effect of personal taxes, so the average benefit of debt is around 30%. And after thinking about personal taxes, these numbers generally become very small, right? Less than 5%. And for some provinces, the tax advantage of debt even becomes negative. It essentially means for these provinces, tax generate disadvantages. Okay, now let's proceed to this classic topic, valuation. So here we will only talk about a very specific case. That is, we will think about how permanent debt will change the firm's value by considering personal taxes. We learned in the last lecture, if a firm has permanent debt, and if we only consider corporate taxes, then the firm's levered value is given by this formula. And we also understand TC is the tax advantage of debt when we don't consider personal taxes. So this essentially implies that if we consider personal taxes, we should get a very similar formula, right? At least the form of the formula should be the same, just with a different twist. That is, instead of using TC to measure the tax advantage of debt, we should use T star. That is, the tax advantage of debt after considering personal taxes. Oh, by the way, you can also clearly see that because T star is generally smaller than TC, right? So this implies that because of personal taxes, firm's value will decrease. Okay, now let's see this example here. Estimate the value of Midco after its $100 million leveraged recap. And here we have to consider personal taxes. And we will basically use the average tax rate across all provinces and territories. So remember the process we just discussed. Right? The process of thinking about leverage recap is it's a two-step process, right? So first you have to do the valuation. That is, what is the firm's value after this leverage recap? Well, we will just use this formula here. Now, what is VU? Well, VU is just $300 million. That is 20 million shares times the share price. And debt, we know there is $100 million debt. So it's T star times one, oops. So it's T star times 100. So our task here is basically about calculating T star. Right? So T star is and the problem says we should use the tax rates averages across all provinces and territories. So basically we will use this number as the corporate tax rate, this number as the tax rate on interest income, and this tax rate as the rate on equity income. So after plugging these numbers, we will find out the answer is actually 1.1183. Right? So we could just directly use this number here. Oops. So it's 1.1183%. This implies after leverage recap, the firm's value would be given by this, which is 301.1183. And now, how do you find out the share price? Again, we know all original shareholders will benefit from this leveraged recap. So this essentially means the share price equals the total value of equity divided by number of shares. Note that the total value of equity is given by the value of firm after leverage recap minus the amount of debt. So this gives us a number of 15.055915. So you can see that for this leverage recap example, after you factor in or considering the effect of personal taxes, the stock price increase actually becomes very small. Right? Remember, our previous answer to this type of question was $16.75, right? When there were no personal taxes. So it's a very large difference. Okay, now let's examine firm's optimal capital structure with taxes. So basically what we have learned is, even considering personal taxes, still firm will get some positive benefit from using debt. So this is just a theory. we want to understand whether this theory is consistent with our observations. So we want to examine in real life, in actual economy, do firms actually prefer debt, right? So we basically want to look at some data and examine how firms were using debt. And what were our findings? Well, the findings are basically like this. First, most firms' investments are supported by internally generated funds, such as retained earnings. Second, the use of debt changes greatly by industry. So we basically want to ask ourselves the following questions. If using debt is beneficial, why do firms mostly use retained earnings instead of using debt to make new investment, right? And then the second question is, why do we see differences in the usage of debt across different industries? So first, let's look at the first observation. So what you can see here is first, obviously, for the vertical, it's the amount of debt. Sorry, for the vertical axis, it's just the measurement in billions of dollars, and in horizontal axis, you have different years. So what you can see here is first, if you look at this red curve, right? So this is the capital expenditure. So this measures firms' investment. And the second focus here is this blue, this blue line, this blue curve. So this guy is the net external funds. That is the total amount of money firm get from external channels. What are external channels? Well, issuing equity and issuing debt. So essentially, this blue curve here gives you the total amount of money firm gets from both equity and debt. What you can see here is there is a large gap between the capital expenditure and the net external funds, right? So you can see that the gap here is actually pretty large. So this basically means that firm is only using a very low level of external funding to fund its expense on capital expenditure. So this is kind of weird, because if debt is so good, why don't firms issue more debt to finance their investment? And you can basically ignore these bottom two pictures. Now let's look at the differences across different industries. So basically the horizontal axis gives you the debt to value ratio. That is debt divided by firm's enterprise value. What you can see here is there are large differences across different industries. For example, for this high-tech information technology industry, the debt to enterprise value is below 5%. And then if you look at the utility industry, so you can see that its debt to value ratio is close to 50%. So this is obviously a very large industry, right? Sorry, this is obviously a very large difference. Now, seeing these observations, these results, we have two questions to ask. The first is, why does debt make up less than half of the capital structure of most firms? Because you can see that for all these firms, debt makes less than half of their capital structures. The second, why do we see these large differences in leverage choices across different industries? Now, the first theory to explain this is there are limits to the tax benefit of debt. So this idea here is very simple. If you think about how firm gets the tax benefit of debt, well, the basic premise for the firm to get the tax benefit is it has to have taxable earnings, right? So if you think about the income statement, so you have EBIT here, and then you have this interest expense, and then you have earnings before tax. So this is essentially the firm's taxable earning. And the firm will only get, so firm will get tax benefit if and only if earnings before tax is larger than zero, right? So if there's no earnings, the firm does not need to pay tax, so there's no tax benefit. Now, what is the formula for EBT? Well, it's pretty easy, right? So EBT equals EBIT minus interest expense. So if we require EBT larger than zero for the firm to benefit from the tax savings, then we can see that EBT has to be larger than interest expense for the firm to enjoy the benefit from using debt. Right? So this basically tells you that from the perspective of tax savings, the firm should never make interest expense exceed EBIT. This is also clear from the following example. So let's say you have an EBIT of $1,000. And if interest expense is zero, then of course, income before tax would be $1,000. And the firm has to pay $300 and $350 of tax. So the net income would be $650. Now let's look at these two cases. High leverage and excess leverage. So why the third case is called excess leverage? Well, because interest expense exceeds EBIT. Now, what's interesting is about the amount of tax. So basically, you can see that if interest expense is just equal to EBIT, the firm pays zero taxes. Now, if the firm use excess leverage, the firm still pays zero taxes. So this basically tells you that there's no additional saving from using excess leverage. That is, from the perspective of tax saving, a firm should not make interest expense exceed EBIT. And then there is this additional problem. Well, remember we discussed the difference in personal taxes, and our conclusion was because tax on interest income is larger than equity income. So the tax difference will actually reduce the benefit of using debt. This actually implies if the firm is using excess leverage, there could be additional cost, which could reduce the firm's value because the tax rate on interest expense is so much larger compared with the tax rate on the equity income. You can see this from a very simple calculation. So we have learned the effective tax advantage of debt is given by this formula. Now, if the firm is using excess leverage, this basically means corporate tax rate is 0, right? Because the firm does not need to pay corporate taxes. So in this case, we get the following formula. Then this equals 1 minus TI and TE minus TI. And importantly, we know generally the corporate tax rate. We know generally the tax rate on equity income is smaller compared with the tax rate on interest income. So this number would be smaller than 0. What does this tell you? Well, it tells you the tax advantage of debt becomes negative. That is, when you're using excess leverage, you don't get tax advantage. You will actually incur tax disadvantage. This will actually reduce the firm's value, right? So you can see that the optimal level of leverage from a tax saving perspective is the level such that interest payments equals EBIT. You don't want interest payments exceed EBIT because this will not generate additional tax savings and it will actually generate some cost because of the large tax on the interest income. Now, there is another factor which would further reduce the amount of debt the firm will want to use. So this factor is uncertainty. The idea is like this. If you, as a firm, you know the future the future EBIT is $1,000 for certain, then you will just try to pay the interest expense at $1,000, right? But in reality, generally you cannot precisely forecast what is your future EBIT. So let's say if your EBIT is either 1,200 or 800 with 50% chance each. Now, do you really still want to use $1,000 of interest expense? Is this a good idea? It's not, right? Because you know that if you get this result, if you're having a bad year, if your EBIT is only $800, then you will have excess leverage, right? So you will suffer from this excess leverage. So basically this uncertainty will prevent you from using this high level 1,000 interest expense. Maybe if you're conservative, right? Due to this uncertainty, you will just use $800 of interest expense. So this can be summarized by the following picture here. What you can see here is first you have this red curve. So this red curve first increases and after $1,000 it decreases. Basically the slope of the curve is given by this tax advantage of debt. However, you can see that after exceeding $1,000 of interest expense, you will have excess leverage. And the tax advantage of debt will become negative. So that's why you have a downward sloping line here. Now look at this curve, right? So this blue curve tells you the expected tax saving if there is risk. In this case, you can imagine that there is some uncertainty in this firm's EBIT. You can just consider the example we just discussed, right? So maybe it's either 1,200 or 800. And now, in this case, you can imagine that the firm will not want to use $1,000. So maybe it will just want to use $900 of interest expense due to this uncertainty, right? So to summarize, we just discussed two forces to reduce the firm's use of debt. First, it's this effect of excess leverage. A firm will not want to have excess leverage, so interest expense should not exceed EBIT. The second channel is, well, firms cannot precisely forecast EBIT in the future, so they cannot really use a high level of interest expense. Right? So this uncertainty further depresses the level of debt in firms. Okay, so now let's explain why do we have some observations. So remember we observed from data that high-tech firms, they generally have very low debt to value ratio. Right? That is, let me remind you this picture here. Right? So for these guys, they have very low debt to value ratio. So why this is the case? Well, we can consider a special case that small firms or young firms, because we know that a lot of high growth tech firms are actually young firms. Well, if you're a young firm, right, you don't have any taxable income. And if you don't have any taxable income, then you should not use debt. Right? So if you don't use debt, obviously you will observe that debt value ratio is almost zero. Right? So it's the simple fact, or you could say, hey, if EBIT is zero, now my interest expense definitely should be zero. So no debt. Right? So very easy to understand. And then there is the third reason, that is deductions and tax credits. So generally a firm would have a lot of tax shields and other deductions and all different kinds of tax credits. So because of these other tax shields, then its taxable earnings will further be reduced. So it will further use less amount of debt. Okay, now if we summarize our finding is generally, right? Generally, interest expense should be close to the EBIT level, right? Of course, due to uncertainty, you don't want to interest expense to be exactly the same as EBIT. But you should imagine that, well, maybe interest expense should be close to 80% of EBIT, right? Something like this. At least you're expecting a large percentage, such as 80% or 85% of EBIT as interest expenses. Right? But if you look at the data, you can see, well, this is not true. So if you look at this interest expense to EBIT ratio from 2002 to 2013 for Canadian firms, what you can see here is this ratio never exceeds, I would say, maybe 32%. So EBIT divided by, so interest expense divided by EBIT never exceeds 32%. This is quite low, right? Because according to our theory, we should expect the interest expense to be close to EBIT. Maybe we would expect 80%. But why do we only get 32%? Right? This is interesting. And we could also observe the same thing if we look at this internationally across different countries. You can see that in 1990, most countries, except maybe Canada, most countries have this low interest EBIT ratio, right? So why? Well, the reason is if you increase the level of debt, then the probability of bankruptcy will be larger. And bankruptcy is very costly. And this additional bankruptcy cost will further reduce the tax advantage of debt. So, because of this additional cost, firms will use even smaller amount of debt, right? Okay, let's review this chapter. With corporate taxes, how does firms' value change as leverage changes? If there are only corporate taxes, and if you don't consider the bankruptcy costs, then the answer is firms' value will increase as leverage changes. So how can you see this? Well, you can actually use a very simple formula. Remember that if we consider the case of permanent debt, we know that if there is permanent debt, then the interest tax shield is given by corporate tax rate times the level of debt. So basically you can see that if you increase D, the amount of debt, then the firm's value will actually continue to increase. Okay, now what about the second question? How does leverage affect a firm's weighted average cost of capital? Well, WACC equals and you can further write this as and this is just pre-tax WACC. Oops. So we can basically hold pre-tax WACC as a constant. And what you can see here is as you increase the amount of debt, this term will increase. So this basically means WACC will decrease. So the answer here is increasing debt will reduce the weighted average cost of capital. Of course, this would only hold if we don't consider bankruptcy cost. Okay. Let's look at the third question. How can shareholders benefit from a leveraged recap when it reduces the total value of equity? Well, this actually looks interesting, right? So it basically tries to confuse you because it says, hey, leverage recap reduces the total value of equity, but why shareholders can benefit? Well, if you recall what we have learned, we learned, so in this Medical example, right, this firm would repurchase $100 million of shares. And in the end, we find out, what happened? Okay, sorry. And in the end, we find out the value of equity will become $235 million. And we know that before repurchase, the value of equity was given by 20 times 15, 300. So you can see that the value of equity actually decreases. But does this imply shareholders, they're hurt by the leverage recap? Well, it's not. The reason is because the $235 are just the valuation for the leftover shares in the market. you have to think that in the process of leverage recap, the firm has paid $100 million to shareholders, right? So you can see that the total value returned, or the total value of shareholders, is actually the value of the leftover shares and the cash, right, paid to these shareholders. So shareholders actually benefit from this leverage recap. Again, of course, you have to say, well, in this leverage recap, using debt generates the interest tax shield, which increases the firm's value, and then this value will be captured by all shareholders or original shareholders, so they will benefit from the share increase. They will benefit from the share price increase. Okay, fourth, the last one. Under current law, why is there a personal tax disadvantage of debt? Well, this is really because of the design of the tax law, right? Because we know that personal taxes are different in terms of interest income tax and equity income tax. So if interest income tax is higher than the equity income tax, it means that at the personal level, interest payment will have this tax disadvantage compared with equity income. Obviously, at corporate level, interest payment has tax advantage. So in the end, you will combine these two effects. That is the advantage of debt at firm level and the disadvantage of debt at individual level. So in the end, this disadvantage of debt at individual level will reduce the benefit of using debt. So that's why we would use this effective tax advantage of debt to calculate what is the benefit of debt at the personal level.